So we'll go ahead and get started. Got 10 o'clock here. My name is Dale Lattz from the Ag Econ department here. Joining me today is Bob Ray, who is CEO of the Illinois Farm Business Farm Management Association. Bob took the trip over this morning from beautiful Camp Point, Illinois, in the western part of the state. Title of our program today is Paycheck Protection Program, PPP. A lot of you are familiar with that already, but with legislation that was passed at the end of December, got some new wrinkles, some extensions on some things and so forth. We'll be also touching on the employee retention credit, which is a credit that can be fairly sizable if you qualify for farmers that have employees. Some of the topics again today, as we look at our agenda, again, talking about PPP and idle recent updates. Again, legislation was passed December 27th. Included something called a farmer PPP, and we'll touch on that, and also a second draw for the PPP program. Give some details on that, and also then finally wrapping up with the employee retention credit and getting into some of those details and what that can amount to in terms of some tax savings for farmer employers. So Bob, why don't you kind of get us up to speed on some of the recent updates from the legislation that was passed in December? Some very positive things for the most part, I think, for taxpayers.
Yeah, very good. I agree. This is really helpful to simplify and provide economic benefits to people. And so as we dig into this, I hope everybody's ready for some fun about finance and tax. I mean, Dale, I can't imagine a better thing to do on a 28-degree day than talk about finance and tax.
Well, at least
here in Mumford Hall.
Yeah, if you're like us doing record checks and things like that, farmers doing office work, it's easy to do when you're out there looking at this weather.
No kidding. It is the thing. So these all came from the Consolidated Appropriations Act. That's the condensed version of legislation passed on December 27th. And actually, Dale, my wife and I were celebrating our 40th wedding anniversary with a Zoom call with a bunch of people. When across the room, what did I notice? But CNN ran across the table along their little label here. The CAA was signed by the president. And I stopped our middle of our 40th wedding anniversary celebration and said, Debbie, this is going to be a really awesome tax season. And here's what happened. So these are good news. Expenses that were paid with your PPP loan are now deductible. We always thought they were, but then for a while in the middle of the year, IRS said no, but we have these deductions back. And so you'll be able to claim those as a 2020 tax deduction on your return without any adjustments. The PPP loan itself is not included as income. So the PPP loan process is really a tax-free endeavor. There were some people who took idle advance grants. These were economic injury, disaster loan advance grants a year ago. They capped at $10,000. We thought they were taxable. This legislation said no, they are also tax-free money to the recipients. For a while, we also thought that those same grants reduced your PPP forgiveness amount. So let's say you had a PPP of $15,000 and you also had an idle of $3,000. We thought your PPP would be left with a $3,000 balance. It would not be fully wiped out. And this legislation eliminated that rule. So if you took an advance grant, you also get to keep your full PPP forgiveness. They do not reduce one another.
Bob, I'll just mention on that, I have had a few already that were in that situation and actually paid back their $2,000 or $3,000 to their lender and some interest. So I assume those producers that did that will be getting, if they haven't already, be getting those funds back through the lender via SBA, I guess.
I think so. We saw how the contractor who's doing that for SBA is going to make that look. So it appears that SBA is going to maybe send a lump sum payment to the bank for all of those payments, and the bank will divvy that up to the people who collected or who had that money withheld from them. So they should get their money back. I think that'll take a while, but this should happen. Simplified forgiveness applications will be available if your loan is less than $150,000. We'll show you that in a moment. And then the other unique piece that made life extra complicated here in January, but also very beneficial to the taxpayers, is that employee retention credits and PPP are available to the same taxpayer in 2020 and 2021. When this started last April, you had to use only one of those two benefits. You had to pick one. Most people picked PPP because it was better. but now they can have both. The only caveat is you can't use the same wages for both benefits. And for most people, that won't be a big challenge, but there is a restriction there. As we think about the 2021 PPP round, and I've just chosen to call all these are 2021 PPP. There's a lot of different nomenclature being used, but for my mind, I want to think about the 2020 PPPs, and I want to think separately about the 2021 PPPs. And in the 2021 PPPs, there's 3 ways to draw additional funding. If you had never applied in 2020, you could now apply for your first initial draw. Maybe you were ineligible. Maybe you didn't have a very large income, a net income, so you didn't think it was worthwhile. Maybe whatever reason, you just didn't make an application. Whoever did not apply then can now apply for their very first initial draw, and it will be under the same rules that applied in 2020. That's one type of funding. The second type of funding available is a recalculated first draw. For those people who did apply in 2020, but now may qualify for additional funding, they have the opportunity to do a recalculated first draw. More details about both of those as we come up to more slides. And then the third type of funding available is a second draw. So this would be people who receive their first draw either as an initial or a recalculated first draw. They also have to meet this 25% less gross receipts test in 2020 versus 2019. We'll detail that out later today as well. But Dale, I think it's important. There's 3 different things here as we think about 2021 PPP. They each have some unique calculations and rules to them.
Yeah, Bob, it could get complicated fairly quickly. You've been in touch with some lenders in your areas and others across the state. Have you got a feel of what lenders are doing right now in terms of these 3 draws? Are they doing one or the other, or is there an ordering here that we may need to think about?
Yeah, that's a great question. The recalculated first draws did not become available through SBA until Monday, 2 days ago. And my understanding is that's not working very well and through the SBA portal. And so I'm not sure that any of those have actually been submitted or certainly probably not processed yet. And some lenders are taking a wait and see approach till we get more clear guidance and process for that. So I think some people, the easy ones are the first initial draws, especially for farmers. We'll see that in a moment. And then for some other people, it is second draw. I was in office yesterday and they had done, just while I was there, 2 of these second draw applications.
Okay.
So 2021 PPP, there's this very unique calculation for individuals that file Schedule F. And I've highlighted here, these are individuals. So they're Form 1040 filers that file a Schedule F. They're able to use their 2019 or 2020 gross income. The gross receipts for the year, for a lot of our farms, that's a big number. I mean, a few $100,000. The old rules required using net income. And so the issue happened if I had a loss, what happened? You weren't eligible a year ago, but now you are. And we further clarified that these PPP proceeds aren't taxable, not taxable. The expenses remain deductible. So all of these, both 20 and 21 PPP programs do not generate any tax liability for the borrower.
As far as documentation and that first draw, if I had a negative F last year, probably the Schedule F is what the lender will want to see if I want to go in for the first time. I wasn't eligible last year, didn't have any employees, just myself, and I had a negative or very low F, so I didn't apply or didn't think it was worth it. They can go in now and
I think that's right. For the initial draw, it's really as simple documenting that as your 2019 or 2020 Schedule F, whichever has the highest gross receipts.
That's a big boon for some people that, especially with some of the tax laws and how we handle machinery trades and so forth now, and large amounts of depreciation potentially that can knock that Schedule F net down.
Yes, this group was locked out of being eligible to participate a year ago. And so we had to tell a lot of people, even though your 1040 AGI is $80,000, but because your Schedule F is -10 and your 4797 showing machinery gains is +40, you're ineligible. Well, this solves that. And now we're going to look at gross income to let people qualify for the 2021 PPP initial second draw, recalculated draw. One of the questions is about 4835 filers. They're not going to be eligible yet because the whole definition of being eligible is the drive towards net self-employment income. And even though farmers have this unique piece about using gross receipts, they're still driven to net self-employment income. 4835 filers, Dale, I don't think have any benefit provided in the rules yet today.
Yes, it's not self-employed income, and we believe those don't qualify and haven't qualified in the past.
We have a question about forgiveness, but let's cover one more slide here, and then we're going to talk about the forgiveness piece soon. The other new piece in the CAA were some payroll tax credits that farmers need to be considering. Well, we're doing W-2s and 943 payroll filing like right now. They're due on Monday, February 1st. So it might be a little late to raise these issues, but it's really not, because if these have not been identified yet, if your tax liability is paid in full, your 943 form isn't due until February the 10th, first of all. And if you've missed out on an event and you've already paid the tax, there's always the opportunity to amend your return and gather these credits later. So the sick and family leave credits actually came in the CARES Act back in March. And so if you have employees who are unable to work, there's some credits that can be claimed for them. So notify your tax preparer if you have employees unable to work, you might have some payroll credit. This also will apply to you as a self-employed farmer as well. When you file your 2020 tax return later, you will be able to claim some credits against your self-employment tax on your Schedule SE. We've never been able to do that before, but these will qualify for some credits to pay part of your tax. The employee retention credit, a different calculation. This was new in December. You have to have a gross receipts reduction in 2020 of 50%. For the PPP second draw, it's only 25%, but here it's 50%. The benefit is a potential $5,000 per employee per year tax credit. We'll get into that in a little more detail. So go ahead, Dale.
And Bob, I was just going to say, when we'll get into the detail, but when we talk about the gross receipts drop comparing 20 to 19, that is on a quarterly basis review instead of the whole year, correct?
Well, you can measure it either way. If your annual 2020 receipts are more than 50% less than 19, obviously one of your quarters had to be down. Yeah. So if you pass the annual test, you're in, but more precisely, you're correct. You're going to be looking at this on a quarterly basis, on a calendar quarter basis for these reductions to see if you're able to open the gate to participate in this game.
So if I look at the annual basis, like you say, I don't, that doesn't mean I don't want to delve in a little deeper and look at a quarterly basis. I might still be able to qualify based on a quarterly drop.
Yeah, step one annual. If that doesn't work, go to step two quarterly.
Okay.
PPP certifications. I'll let you describe some of these, because these are the same as we had earlier in the 2020 PPP. And it's important to remember kind of some of the basic elements before we even get into the details.
I think the first bullet point we have up there is very important, and that basically says, and this is a question on the application, I believe, Bob, worded something like this: that current economic uncertainty makes the loan necessary to support ongoing operations. That's kind of a broad definition there, not necessarily very specific. Doesn't say dollars and cents what has to have a drop or things like that. And some of the original language that came out earlier last spring also referred to liquidity, and also the need to go outside or need for this loan because I couldn't get a loan someplace else, or I was liquidity problems I was having. You know, that's kind of the big umbrella that we don't talk about, maybe the big gorilla in the room. And in essence, we get into the details a lot on how to do this and so forth, but we need to keep in mind some of these general certifications that we have to make about the need for the program. We've not been audited. We haven't had specific guidelines on this yet, but that is out there.
I think the other thing that we didn't know a year ago is as the 2020 PPP season concluded, Congress pressed and SBA obliged, and they published the names and amounts of all of the borrowers in these programs. So if this was the condition and you're a PPP borrower, you need to be comfortable with the fact that your name will be made public in some form that you've acquired these loan proceeds.
Some other details here: you do have to be in operation on February 15th of 2020. That goes back kind of to the original guidelines or certifications that we had when we first came out. That still is in place. Business still has to be ongoing, if you will. It's not been closed or not permanently closed. And again, your U.S. principal place of residence is a place of residence for all your employees. So those are some of the background certifications you need to keep in mind as you talk about employing this.
Right. Those will be initialed on your application, and we'll see in a moment. So we'll go on to the next slide, Dale. We have a couple of questions, but let's get to the details, and these will match up very well. So they described a new definition in the current round. They're called Farm and Ranch PPP loans, and it's based on your 2019 or 2020 Schedule F Form 1040 gross receipts with a maximum of $100,000. You take that $100,000 divided by 12 is your monthly receipts, times 2.5 is the definition in the law. That gives you a maximum loan amount of $20,833. And I think this is the maximum loan amount that individual can get from all sources of self-employment income, Schedule C, Schedule F, or even a partnership. That's the most. So this allows those 2019 Schedule F losses to now be eligible to apply. They were not allowed because it was based on income before. And even if your Schedule F was something less than $100,000 net, you might be eligible for a recalculated draw and get up to that $20,833 amount. So one of our questions is, if you applied in 2020, took your initial draw, and you've since been forgiven, can you still pull a second draw? Yes, the forgiveness is allowed for the second draw. If forgiveness has happened, you're ineligible for a recalculated draw. We have another question. I didn't have a 2019 Schedule F. I'm a first-year farmer. Well, that's okay. If you were in business on February 15th, you can use your 2020 Schedule F. That might not be prepared yet, but your records will identify at this point your gross receipts in 2020. And based on that, you will go through the math and determine your PPP loan amount.
I think in a situation like that, it will be good to have some kind of documentation in the files that you can prove. Say if you're a grain farmer and 2020 is your first year, you may not have a lot of activity till the spring, but you probably have opened up a bank account. You might have signed some leases already. You might have purchased some inputs before February 15th date. So if you can document that, have that in your files just in case if 2020 was the first year of your farming operation.
Right, good point.
You need to prove, maybe need to prove down the road that you were in business as of February 15th.
Correct. Yeah, good point. So the initial and recalculated draws, I put those on the same page here because they both get to use these farmer rules. And we describe that just means you can rely on gross receipts instead of net. Nobody else, no other industry has this opportunity to use gross receipts. It's a very specific to the farmer condition. The maximum amount they're going to draw is $20,833. If forgiveness is completed, they are not eligible for a recalculated draw. And this is a really kind of a questioning point. Well, it's a big questioning point, frankly, because the CAA rule said if forgiveness has been completed by December 27th, you're not eligible for a recalculated draw. But later guidance from SBA leaves out that date requirement. It just says, if your loan has been forgiven, you're not eligible for a recalculated draw. This is a very unfortunate circumstance for people in those conditions. We're hoping that there's going to be a way to solve this going forward, but it appears it's more of an administrative challenge. If my loan's been forgiven, I'm sort of out of the SBA system. There's no way for the lender to go in and sort of recalculate and repopulate my loan because it's gone. So we'd like to find a better answer than that, but that's my answer today. The recalculated draw covered period begins on the date of your original disbursement. So if you're taking this recalculated draw, you had one in 2020, but I can get more under the new rules. that recalculated draw is really a restatement or Dale, you're the banker here, but a change in terms of your original note. And that date goes back to your original disbursement date to measure your covered period. And so I think for the recalculated draws, that covered period ended many months ago, or certainly several weeks ago.
Yes.
It doesn't appear that language exists for the initial draw covered period. It looks like that begins with the date of your initial disbursement, which might be today. And then we have a covered period problem we have to kind of work our way through. We'll talk about that in a moment. This says if you're an employee for another organization, you're paid as an employee through PPP. Does it affect your self-employment income? Well, if you're in another organization, there is a ownership requirement before it affects you. And I was thinking if you're a more than 5% owner, it does affect your self-employed PPP. I'd like to check that percentage amount, but it depends on how much you own of that other company. But if you only own, 0.1% of stock in a major company, that's not going to affect your self-employment PPP amount, but there is an ownership level where it does.
Yeah, that was a question that had come up. So, yep.
Second draw PPP. This is the one that is also, I think, underway. These applications were maybe even some of the first that got done, but they have to meet this quarterly gross reduction requirement, 25% less in any one matching quarter. So the application requires you to put in 2020 quarter 3 gross receipts, 2019 quarter 3 gross receipts, and those have to be 25% reduced in 2020. And we've seen many conditions, Dale, where the 2020 annual receipts are higher than 2019, but one quarter is lower and they open the gate and they're in the game.
Yeah, when you think about this, from a grain farming standpoint, it really kind of depends a lot on when you market your grain. And in the calculations I've seen, not everybody qualifies, obviously, but it's not unusual necessarily for a grain farmer that maybe sold all his stuff in quarter 1 after the first of the year, 1 year, and now the second year has held it off to quarter 2 or something like that. So that, along with when FSA payments are received and things like that, does affect and may make some grain farmers qualify, even though their gross receipts between the 2 years may be not that much different for the whole year, but they can be different by quarter.
It's as simple as having a grain sale March 27th 1 year and April the 2nd in another year.
Mm-hmm.
The loan amount for these will generally be equal to the 2020 PPP. You can also utilize your 2020 payroll, so that might make it be higher. You had to have received a first draw PPP, and before you receive the second draw PPP, will have used the full amount of the first draw for your eligible expenses. The 2043 application has that specific certification requirement.
So, Bob, on eligible expenses, just getting off a little bit of a tangent here, for the self-employed individual that does not have any employees, just has and did qualify and receive the whole $20,833, the eligible expenses can be, as far as the 60% payroll rule, is the payment to himself as the owner compensation amount, I guess, from that.
Yeah, and in fact, it could be 100%. All of that amount could be the $20,833 draw to themselves. The official term in the code is the owner compensation replacement. So all of it could be a paycheck to yourself as a draw. Gross receipts calculations are very tricky and very important in both the ERC and PPP discussion. This comes from one of the latest pieces of guidance from the IRS last Tuesday night, January 19th. And here's how you calculate gross receipts reductions. And based on your entity choice, each bullet point is a different entity. But you'll notice the second line item, self-employed farmers, IRS Schedule F, the sum of line 1B and 9. 1B is where you would reduce gross receipts by cost of cattle sold as one example. So you add that back to your gross receipts number. So this is the latest that comes from SBA on how to do this calculation. It's pretty straightforward once you have the tax form in front of you, Dale. Partnerships. This is one group that is not treated as favorably in this round of PPP. But they also have one important distinction. The initial draw for net self-employment income can be made if it wasn't done in 2020 because the partnership rules changed in April of 2020 and some people were not able to get in initially. So if you have net self-employment income, you can make your initial partnership PPP draw for that amount. Cannot use gross farm income as individual Schedule F filers can. And I would say there's a bit of controversy about my statement there, Dale, but as I read it, it's pretty clear to me they're stuck with gross farm income for the partnership. I see the other argument that allows them, that makes them think net farm income might be usable. But we'd certainly like SBA to clear that up. But as I read them, I think it's gross farm income. These partnerships might also be eligible for a second draw on self-employment income as described in the first bullet and their payroll. And as in 2020, the partnership has to make this application, not the partners.
Bob, we got a couple of questions up here. So for fiscal year entities, is it still 2019 and 2020 calendar year? I think would be the question there, and I believe that's correct. So we're looking at calendar year comparison, and if I have a fiscal year corporation or entity that ends in June or something like that, it's not the fiscal year comparison to the fiscal year. Is that your interpretation?
Yeah, in the same document I showed just a moment ago with question 5, they added one piece to this, and I agree. Generally, we're looking at calendar quarters of measurement for these gross receipts testing. For the employee retention credit, I'm fairly sure about that because that's going to relate back to calendar year W-2 filing and payroll reporting. There was an alternative that if your fiscal year could include all 12 months of the calendar year, you could use your fiscal year annual totals for your measurement if, again, 20 fell 25% below 2019. So a very unique aspect there. So if your year begins in what would that be, February or January, February, or March, then you might have all 12 months of your fiscal year also in the calendar year. But generally, we're looking at calendar year measurements. FSA payments are included in gross income. We don't know of anything that would be excluded from that that's not reported on your Schedule F.
That's basically all those lines that get to gross income. There's 8 or 9 of them or something like that on the top of the Schedule F. There's other things in there besides FSA and grain sales, could be crop insurance income and things like that.
I agree. Let's get a couple more topics and we'll come back to the questions that you're monitoring, Dale. We have on the screen here the 2 applications that are available, the 2483 for initial or recalculated draw. I wrote that last week and I might even change my mind today about that because I heard yesterday that SBA was going to not require a second 2483 for a recalculated draw. But I'd start with that. The other caveat that we didn't mention early on, Dale, is this program is highly closely tied to the borrower and lender relationship. And so these finite, detailed questions, the lender is going to make the call. It's their world. It's their money. We're going to rely on them to make the final decisions on these processes. And there's a second application for a second draw that includes a place where you measure your gross receipts definition.
A couple things, Bob, as you mentioned that about the lender relationship on the recalculated draw, where they want to try to go back and get additional funds. If they're able to do that, they need to go back, obviously, to the original lender.
Yes,
that was the lender that they got the original loan out, and they would still have that on the books. And if they are eligible to kind of add to that, they can't go to a different lender.
That's
they need
correct.
To go back to that lender.
Good point to add. I agree.
Little details like that. And one of the things on the application, and I'm kind of getting off on a tangent here also, in terms of the new law, there was the reduction of the $150,000 loans and less as far as a simplified process for forgiveness of those, maybe less documentation needed than we originally thought.
I think we have a slide about that, but yes, that is true. Okay. I think so. Let's hit a couple more questions populate. Let's get to some examples and do the math. My 2019 loss, 15,000. My 19 gross receipts, 65,000. Could not get a 2020 PPP ineligible, no self-employment income. In 2021, I can get a PPP 13,542. This would be my initial draw, did not apply before. You can see how we got to that math. And this would be my initial draw in this example. If my gross receipts dropped in 2020, I could get this, I could also get the same amount or maybe a little more in a second draw. The second example is still a loss. Gross receipts now 165,000. No PPP in 2020 because I was ineligible based on the net loss. So here's where I get to the maximum 20,833 initial draw amount. And if my 2020 gross receipts drop 25%, I could apply for a second draw of the same 20,833. So you can see, Dale, how it's possible for a farmer to look at a $41,666 PPP loan if the stars aligned and they were able to qualify under both conditions.
So you're telling me if I had a negative Schedule F last year, didn't qualify, didn't get any money because of the rules back then, we're looking at the net, not the gross. Today, I could go in and apply for the first draw.
Yes.
Based on my gross receipts. If they're over 100,000, I would max out and use those funds, maybe get them forgiven and go back and get a second draw for the same amount down the road.
If my gross receipts test would make me eligible for that.
That just seems too good to be true, Bob.
It does sound too good to be true. But again, if we think that through, if not for these unusual farm calculations, they should have received 20,833 a year ago. They're just a year late in getting caught up.
And it's just to clarify again, that $100,000 gross receipts is the farmer rule. It's not
only the farmer rule.
Yes, not
Only
for
the
the Schedule C business or something like that. So very favorable to agriculture.
Correct. We have one final example here. Their net income a year ago was 25,000. Their receipts are over 100, and they received funding last year of 5,208 based on their net farm income of 25,000. You know, the quick math on all these is about 20%. And our 2021 PPP will be 15,625. This again would be a recalculated first draw. They're eligible for 20,833 max, received 5,200 a year ago, get another 15,600 today. If gross receipts dropped in a quarter, another 20,833 second draw possible here as well. We're going to flip to the employee retention credit, but let's answer a couple of questions. Dale, go ahead and take the whatever one you like up there, and I'll take the next one.
There you go. So we got one up here that says, if I file both a Schedule F and a Schedule C, can I borrow under the farmer rules? And I believe that would be a yes answer. We do have a number of people out there that are farmers, but they have a side business, maybe a tile business, a seed business, do some contracting work or something like that. So I'll have a Schedule C and a Schedule F. I believe I can go and use the farmer rules for my Schedule F. Now I can't get a PPP for both the C and the F, or the max is going to be the 100,000 cap. I can't get 100,000 on a C and 100,000 on an F, but I could get a total of 100,000 on gross receipts, and maybe I just file under the Schedule F.
Yeah, and I'll modify that a bit. And let's say my Schedule C net income was 20,000, and I didn't apply before, and my Schedule F gross receipts were 80,000. Between the two, I get 20,833 initial draw loan. But Schedule C net income, Schedule F gross receipts can apply under the farmer rules for the Schedule F item.
So we have another question here. So if you have a cost of goods sold on Schedule F, if you add line 1B and line 9 on gross receipts, you are not reducing gross income by cost of goods sold.
That's correct. And this question has exactly the right phrases. There is a distinction between gross receipts and gross income. And that was one of our very initial questions in the process. But as you saw on the slide we showed earlier, those costs of goods sold do get added back. And so we're looking at gross receipts, not reducing gross income by cost of goods sold. Exactly correct. How do we document that you were paid your recalculated first draw if the covered period ended months ago based on the original date of disbursement? Well, that's a really good question because we're trying to document something that happened long ago. If you're unable to document that by draws that you took a year ago from whatever method, I still think you have time to document that by spending that first draw even yet today. But this is another really good detailed question that we would rely on the lender to dig into that detail for and how their interpretation of that might be. But my hope would be that sometime in 2020, you took draws of at least $20,833 and were able to maximize that amount for forgiveness. The last one we have is a subchapter S. They're not eligible for the farmer rules. No. I think the only people eligible for the farmer rules are 1040 filers with a Schedule F. So the subchapter S could potentially get a second draw PPP, but only based on the payroll that the subchapter S corporation had in 2019 or 2020.
Similar to the partnership where they're looking at basically the self-employed income from the partnership, not the gross receipts of the partner.
Correct. And the other difference would be the subchapter S wouldn't have any self-employment income inside the entity itself, but they would have more wages. And a C Corp filing 1120, exactly the same rules. They can't use the farmer gross receipts, but they could apply for a second draw PPP based on either their 19 or 20 payroll, whichever's higher, but only on the payroll portion for a second draw.
Bob, let's move ahead here a little bit. Employee retention credit. So
yeah, let's switch gears.
Switch gears here. Employee retention credit. What's that all about?
Well, this is these credits have been around for a while, but never applicable to ag in the way they are today. The CAA made two significant changes. Number one, they said if you receive the PPP, you also can get an employee retention credit. That was not true for all of 2020 until my 40th wedding anniversary when the rules changed there. The other piece they changed was they made it much more favorable for 2021. This ended December 31 originally, but now they've extended through June the 30th of 2021. And there are much more favorable rules for 2021. So as we talk about the benefits in 2020, Dale, and an example we'll show you, notice what happens here in 21. In 20, it's a maximum $5,000 credit per employee per year. In 21, it's a $7,000 credit per employee per quarter is what I mean by the big Q there. For $14,000 potential credit per employee in just the first 2 quarters of 2021. And the other distinction is at the bottom of the screen. We have to have a large reduction in receipts in 2020, 50%, but in 2021, only a 20% reduction in receipts. More people will be eligible, and a credit will be almost triple what it was in 2020.
Where do I take this credit at, Bob?
This credit's going to be claimed on their Form 943 if they're an agriculture employer, on Form 941 for all other employers, and in am I trying to think, will there be a chance to get an advance refund of that in 2021? I think so, by filing a Form 7200, I think. But generally, you're going to claim these when you're filing your payroll tax forms.
Bob, another question. As you mentioned a little while ago, we're running up onto the deadline here of filing 943s. A lot of people, or most people, probably have them filed already. What if I've filed this and now I'm learning about, I filed my 943 already and now I'm learning about this credit? Am I out of luck?
No, not out of luck at all. This credit, if you've already filed your 943, no alarms, you can always amend your 943. We've been visiting a bit about this. I haven't looked for a couple of days, but that amended form was not available the last I looked. It had a draft date of December the 10th. But there will be a form available to amend your return and claim these credits. No sweat. IRS will send your money back. And the unique piece about this is these credits, well, there's several unique pieces. Why did I just say that, Dale? There's tons of unique pieces. But the credit amount that's determined also has to be used to reduce your expenses on your 2020 Schedule F. So before you file your individual tax return, you'll have to know your employee retention credit amount, or you'll have to amend both your payroll tax forms and your tax forms later, because this credit, this one is a taxable event. PPP is not. This credit is taxable, and it generates the tax by virtue of reducing your Schedule F deductions.
So let me try to clarify this a little bit, Bob. We're getting deep into the water here, but the farmers file a 943 to pay their employment tax. That's due generally at the end of this month, unless they paid up, then they got to February 10th. So that's when we talk about amending a return,
Sure.
We're talking about a 943X. So that's a 943X, which can be used to amend or correct the original 943. And
Right.
in this case, we're talking about using the 943X, which they're changing right now, and it's not available as of today, we don't think, because they had to add the lines in there for the employee retention credit and a couple things like that. So that's being modified. So if you filed your 943 already and you go back and review your gross income by quarter and so forth, and you have employees, find out that you do qualify for this credit, you can file a 943X, to take that credit. And again, as Bob mentioned, the other part of that then is you have to reduce your expenses on your Schedule F for 2020 by the amount of this credit, but you're still dollars ahead because you're getting a credit as a dollar for dollar against tax, where a reduction in expenses is going to be whatever percent your tax bracket is in from that standpoint.
Exactly. Let's look at this example, and then we'll kind of come back and rehash how that might have worked. So we're going to say the business was eligible in the third quarter of 2020 because their receipts were half of what they were in the third quarter of 2019. They employed 3 people. Look at those famous people on there. You'll know all those guys.
We're old enough that I
got
remember.
A Cardinal and a Laker and a Jet right there. Their payroll, you see, was listed here. And so for Stan, he will get an employee retention credit of $5,000. That's the max per employee. So once you've paid over $10,000, there's no more additional credit. For Wilt, there'll be a $3,000 credit. And for Broadway Joe, a $1,000 employee retention credit. So even though they paid $20,000 in payroll, the IRS will give them back $9,000 of employment credits. And so your net payroll cost was $11,000 for the year. This is a very valuable credit. And frankly, the more employees you have at the lower wage payment level, the higher value this credit is. If he'd paid one person $20,000, the employee credit would have been $5,000. So he benefited by paying multiple people. And to Dale's last comment, this $9,000 credit then will go on their Schedule F to reduce their expenses and generate a higher taxable income in 2020 by $9,000. So they'll pay tax on this $9,000. They'll, let's say, 30% tax, $2,700 you'll give IRS back. You got $9,000, you'll give them that $2,700 back. You're still $6,300 to the good. Here's an example that I roughly made up just to think through this gross receipts calculation and what it looks like. So here's a Schedule F with my name on it, 4 quarters. You can see way up in 2020 first quarter, down in the second quarter. So there, second quarter, I'm eligible for the second draw PPP because it's 75% or less. I'm not eligible for ERC yet until the fourth quarter when it's 45% reduction in receipts. And at that point, I am eligible for the ERC in the fourth quarter because of the drop below 50%. It's really just this sort of simple, but our farm clients have to help us do this math on these 2 years, these 4 quarters, to determine when we are eligible to get into either game you see in red or blue here. Christine, for example, she has larger receipts in 2019, but she dropped below 50% in quarter 2. So that makes her immediately eligible for the second draw PPP. She's also eligible for the ERC in the second quarter and the third quarter and the fourth quarter as well, because there's a little unique rule that says you're eligible for every quarter until the end of the quarter and when you exceed 80%. So she could look at the second, third, and fourth quarter for her ERC calculation. The reason that's important goes back to one of the very first comments we made. And that was you can get ERC or PPP, but you can't use the same wages for both. So the more times you qualify, the more flexibility you have to use up your wages in some other quarter and retain as many wages as possible for your employee retention credit.
We need to keep moving along here, Bob. Let's kind of touch on some other things before we wrap it up.
Yeah, the key issues that we see out here, the applications require this code to be listed. The Schedule F instructions tell us to put grain farms in as 4 1s and 2 0s. It looks like that's causing some problems in the SBA portal, that they want a more detailed number, something that doesn't end in 2 zeros. And we even had an example that drilled down to a soybean farm that was only eligible to take 1 payroll limit because the SBA, I guess, testing or diagnostics said soybean farmers only need 1 employee in January. Why they said that, I have no idea, but that's what they said. But watch these codes. Don't be surprised if we have to dig a little deeper than what the Schedule F codes have. The Schedule F codes are right, but SBA is asking for more detail. Here's the forgiveness piece. The 1227, other guidance has said if you have forgiveness of your first draw before your application for a second draw, then or for a recalculated draw, let me get that right, you're unable to get the recalculated draw. I'd sure like this to be cleared up because it's just messy. People who read the law said if my forgiveness was not done by December 27th, well, let's get our forgiveness done on January 10th, because that's what the law said. And then on January 19th, the law changed and said, any forgiveness is done, you're out. So that's kind of messy. We like to clear that up. We'd like to clear up this 8-week covered period as well. If the rule truly is, from the time you get your initial draw, you have to wait 8 weeks as part of your covered period, it's almost impossible to get your second draw then, because 8 weeks from now is the end of March. The program ends March 31st. We need that clarified as well. We have a question about that too, because the Paycheck Flexibility Act last June said your covered period is the day of loan disbursement and any day during the next 24 weeks. This legislation says the day of disbursement and any day that is after 8 weeks and before 24 weeks. That little twist in the language is causing some heartburn to try to get this right. And then 4797 gains. Do we count those in gross receipts or not? The initial language said we do. The language I showed earlier in that question 5 says we don't. So I can show you 2 documents that say one is in and one says they're out. I wish I knew the final answer. This is the application that people will file if their loan amount is less than $150,000. And these are the 2 questions that people have to answer, only 2 here. And if we hearken our days back to Saturday Night Live and the Chevy Chase formula, there is no math required now on this application. You certify those 2 things and you are done. If you have both an initial or a recalculated draw and also a second draw, 2 applications we think will need to be filed for forgiveness. Those loans that are larger will have one of 2 other options to file depending on their payroll circumstance, essentially. We don't expect to be working on forgiveness applications for at least 6 weeks, but we just wanted you to know what the requirements are. Sometimes these help answer questions on how to properly apply.
All right, Bob, we're wrapping up here. To address a couple of the questions on here yet that have come up.
Separate business has separate EIN. Are they each eligible for a separate PPP loan? I think we also have to look here at the common ownership of those businesses. And if I'm 100% owner of each business, I think I will be limited to a maximum $20,833 loan based on 100,000 net self-employment income. Now, if I'm not a significant owner in the businesses, I think yes, they could have separate loans. The $20,833 fit into an 8-week payment plan on an annualized basis. Well, I think you can take that draw in one check on one day. And I don't know that it has to be spread out over the 8-week period. But as I mentioned, this is an area that's unclear, and there's different interpretations, not only in Illinois, but in other states that we visited with. Do you have to wait the 8-week period, or can you do it all at once? And I think it also depends on whether it's an initial draw or a recalculated draw. Clearly different answers for those two conditions in my mind. Go ahead, Dale. You've got an ERC question. You want to do that one?
If you have a fiscal year corporation that receives an ERC and the return has already been filed for the quarter that they received the credits, so we have to amend the return. I believe that's correct. We would have to amend the employment. When we talk about amending returns, we're talking about amending the 941 or the 943. Well, the 943 on a farm corporation, you just file that at the end of the year.
And I think they might have been inferring in that question that they'd already filed their corporate fiscal year return for an ERC that had been claimed earlier in 2020. Might you have to amend your fiscal year 11/20? And I'd say that is possible. If you earned that ERC, I would say in the second quarter, I would say you would have to amend your 11/20 and reduce your expenses
for that
for the ERC. Yeah.
Okay, Bob. Thank you very much. We're going to kind of go ahead here. And first of all, we'd like to thank all our farmdoc sponsors. We have them on the screen here: Compeer Financial, Illinois Corn Growers, the Center for Farmland Research, the Illinois Soybean Association, Farm Credit of Illinois, and FS Growmark. We appreciate the sponsors. Obviously, they help a lot in supporting this, and we wouldn't be able to do all we do without them. Bob, I mentioned you're CEO of Illinois FBFM. You want to just quickly touch about FBFM, and our field staff are out there in the middle of doing all this type of work right now, and some of the services that they provide.
They're working very closely with the farmers and lenders to try to do the best we can to gather this information. You know, we've never had to calculate quarterly gross receipts before. We've never calculated employee retention credits before. We've never calculated PPP in the middle of our busiest month, probably January. To also get W-2s and 1099s done, you know, we have 70 field staff serving 12,000 farm families across our great state, and they are doing a terrific job to juggle these pieces and learn from a fire hose every day.
We've had a couple more questions come up, and we'll get to those here. We've got a few minutes. Just another slide here that shows the upcoming webinars. We've got kind of another series going on. One Thursday, February 4th would be the next one, commodity title choices. One thing that's kind of gotten overlooked in all this is we had a new farm bill a few years ago. When we signed up for that farm bill, we signed up for 2 years. That was 2019 and 2020 to make our choice in terms of ARC, PLC, and those type of things.
Right.
And we haven't heard that discussion, but actually for 2021, we're going to have to sign up for what we want to do in terms of our choice of PLC or ARC or whatever for 2021. So that's coming up here. It's kind of being put under the blanket here with all these other things that are going on, but that's something coming up, and that webinar will address that. Also, along that time, we're in crop insurance season here again. So ECO and crop insurance discussion, we'll have a webinar on that on Thursday, February 11th. Both of these at 11 o'clock. Bob,
a couple more here. Does a certification regarding liquidity apply to employee retention credit? No, there's no requirement to do that. You paid employees, you get the credit. Who would have thought that we would have been putting accounts receivable on our balance sheet, Dale, for the IRS as employee retention credit they're giving us?
Is it 2008, or excuse me, the $20,833 draw taxable income to me?
Not taxable. It's just treated as a business draw related PPP a non-taxable event.
So that's a loan, and normally when loans are forgiven, which we hope these would be if they're used right, that usually creates a taxable event when loans are forgiven. But by
Correct.
law, PPP loans forgiven are not taxable.
That's right. That was in the original statute and still is there today. 4797 in gross income. Does that apply to both PPP and ERC? Yes. I'm hesitating there because on the ERC, we felt that capital gains were also included in that calculation. And so I believe the ERC calculation and the PPP calculation for gross receipts are different. But if you work your way through the ERC piece, the 943 form, it will give you the details. But I think the PPP and ERC calculations are different for gross receipts testing. The forgiveness app says only $120,008 per owner comp. What if we use 60% owner comp? Can we effectively get more than $100,000 gross? No, you're still stuck with a $100,000 gross limit for your loan amount. However, you can use, and let's say if you have employees, that's important. You could use 40% of your PPP loan for rent and preserve more wages for ERC. So that's a clever play if it applies in your condition. Don't automatically use payroll for PPP. Use everything else first if you have an ERC option.
Bob, that wraps it up. We finished our questions. We want to thank all those that were listening today and also thank for submitting those questions. As you can tell by some of our discussion, we do get into the weeds here quite a bit and get very technical. But it's an opportunity if you meet the qualifications and for those that have employees for the ERC, some dollars on the table out there that we haven't had before that with little work, we might have a few dollars that help pay the payroll tax or some things like that. So
and I would just add to, work with your lender. This is a lender program. They're the ones who are driving the show in SBA. They're the ones who will have to make the call on some of these finite details, in their interpretation. It's their money that's going out the door. So work with your lender. They are trying to absorb this as much as anybody else is. A lot of great lenders in our state doing a good job.
Lenders with PPP, maybe more your accountant type person with the ERC, depending on who files that for you.
Sure.
So again, thank you very much for joining us and have a great rest of the week.
Bye, everybody.